Are your rental properties making money? And is there a better solution? Stay tuned. Welcome to this week's edition of NoteSchool TV, and we are glad to have you today. Let's do a little housekeeping before we get started. Number one, make sure and like this lesson that we're going to do today. Number one. Number two, make sure and subscribe to the NoteSchool TV channel if you have not already done so. And number three, make sure and hit that bell notification bing so that you will be notified every Wednesday right before we're about to go live. When? At 11:05 Central Time. Share this with your friends, everybody you know, especially if you know anyone that's got rental properties, right? Or maybe thinking about that. And if you want to know more about what we do at NoteSchool, simply go to noteschool.com/TV. Again, noteschool.com/TV. And with that, let's bring on our Chief Visionary Officer, founder of NoteSchool, all-around good guy, Mr. Eddie Speed.
Good morning, Joe.
Good morning. Good morning.
Well,
it's summertime in the South.
It is, and we are getting to talk today about something that I'm spending a huge amount of my time and energy, as are you, and that is, what do you do with this rental scenario?
Yes.
And we're going to talk about it and how it's affecting people. And so, yeah, we're gonna have a little working session today.
Yeah, we are.
All right, well, let's pull some slides up and roll the tires on it.
Let's do it. You guys are going to love this.
All right, thank you. So our presentation today, I called it The Great Rental Escape, right? And the reason we did is because this is how sophisticated professionals in the business are achieving 3 times the returns they are on their rentals. And it's doing it without tenants and toilets and, you know, all that stuff, right? Time drain, life suck. And so it's kind of a different way of thinking. We were approached in this along the way, and it's a different way of thinking. So the first thing I'm going to say is a legal disclaimer here, and that is that none of the information that we're giving you today are legal or accounting advice. They're just simply for educational purposes, but we think it's very good information and very timely and very relevant to the market. So just know that if you have to hire an attorney, an accountant, we may talk about those things a little bit today, but we're just doing it for educational purposes. So let's talk about where the rubber meets the road. This is Monica, right? And Monica is a NoteSchool member. And Monica, here's the thing about it. Monica, not Veronica. I know this lady like really well.
Yes.
Monica she did all the things right in life. Like, she worked for corporate America, and she was an executive with Verizon. She had the 401k. She did all this kind of stuff. Yeah. And she had an opportunity for early retirement. And that all sounds really good, but the market had changed, and she wasn't where she needed to be. And because here's the thing, she needed a stable investment, and she had a bunch of rent houses.
Yep.
She was doing rentals. And so she came along, and she figured out this note model was better than rentals. This was just her life experience. It was her discovery. But Monica represents a lot of people here. Some of you are half Monica's age. Some of you are in Monica's situation exactly. And some of you have a little bit different story to it. But the rental property model was pretty much a consistent story that we saw throughout. But Monica definitely experienced this. Yes. And the reason this happened, Joe, is since the virus, everybody, real estate went up in value. Call it double, right? Real estate kind of doubled in value. But the problem is while rents went up, rents did not pace with expenses.
That's right.
And Monica found out she had a house that was making a lot more money.
Worth a lot more money.
but it wasn't making more money, right?
That's right.
It was making the same money, but it was worth more money.
Yep.
It's a little bit like, if you had money in the stock market and your stock market went up last week, well, did you get a check for that? No, you don't get paid to sell the stock until you sell it, right? And so Monica woke up with this situation and realized that and these were all changes, since the virus. So Monica goes back and runs an analysis and really looks at her properties. And it's kind of like this. That house that she would have owned in 2018, it rented for $1,400 a month. Okay. If she rented it today, it would rent for $1,800. So it did go up in rents, right? The rent did go up a little bit, right? But here's the problem. Her expenses in 2018 were $500. Like she was, this was taxes and insurance and maintenance and, all those things we now know cost more money, right? And so a result of it is, she was paying just a smaller percentage of her rent was going to pay the bills. And now a bigger chunk of her money to pay her bills goes towards just paying for the house, right? Paying for the, so she can now rent it out and paying for the taxes and insurance and the maintenance and the painters and the electrical guys and the air conditioning and all that kind of stuff, right? So the reality is she was netting $900 in 2018, and she's netting $900 today. Well, Joe, that's a lot. Your dollar bill won't buy the same money it would buy in 2018, will it?
Nope.
And so she was going backwards in where she thought she was going to be in her retirement. Now, what Monica then figured out was, I'm just normal. There's nothing abnormal about my story. 50% of the money going out in expenses and $1,800 in rent, that's just normal. That's just everybody's story. That's not just, she realized that she wasn't in some unique situation, right? And so you go back and you look at that and you look at these two houses and you have a situation where, that house in 2018, that little rent house there in Dallas, is worth $125,000.
Right.
And that rent house today is worth $250,000. So the good news is, Joe, if you took it what it was worth and what it's worth today, you had an increase in value.
Yeah.
Your house went up in value, right? And so good news. Your house went up in value. But it was making $10,800 a year in 2018. And that was about 8% of what the property was worth. So that 8% is basically just saying $10,800 divided by what it's worth. And it was 8%.
Yeah.
Okay. That was true in 2008. But see, Joe, it's increased in value double.
Right.
And it's still renting the net income after you pay everybody to, not your gross income, but your net income, right? It increased $10,800. And the problem is, Joe, that's half of the net income as a percentage.
Yes.
That's half of where you were. Half as much money. Monica says, that doesn't work.
It doesn't work.
This is going to mess me up and where I'm wanting to go. So if you really look at this number and you think about it, then in 2018, she was making 8.3% technically, right? If you took her income of $10,800, now the house has gone up in value. Yahoo. But it's making 4.3% because, this is the value, right? And this is the net money. How much you net out of it after you pay everybody, right? Sure. And so Monica says this isn't what I wanted. And you've heard it said a lot of different ways, Joe, but I like to say inflation drank your milkshake.
Yeah, that's right. Could be a milkshake or a margarita, right? There's half of it, a third of it there. Yeah.
So when Monica got involved with us, then all of a sudden she starts looking around and she says, well, something must be wrong about my story. Well, this was in Memphis, Tennessee, right? And, and so it was this was true in Memphis, and look at her numbers, right? And 3.6%. Once again, this is net income divided into what the house is worth, right? This is over in the Raleigh area, right? In near Raleigh, North Carolina, over in Cary. And same thing. That's not a good number. Down in Florida, it wasn't a good number, right? And in Missouri, it wasn't a good number, right? A little better number, but still not good. And in the Houston area, Humble, Texas, down the Houston, Texas area, and it was a little better, but it was average about 4%.
Yeah.
And Monica said, this doesn't work. So Monica woke up and said, I want to do this transition that NoteSchool teaches. I want to end up with notes and not rentals. And I want consistent monthly income. I want to get paid for what I should be getting paid for. And then that's going to let me transition my life. That's going to let me move to where I want to live, be around my family. I want to help others succeed. She's a very go-giver person. And she said she feels like this life transition is what let her get to where it's going to get. And Joe, I'd just say that we're just lucky as heck. Neither one of us could take credit for some brilliance. No. We've been doing this industry a long time. We saw the problem and we saw a solution, and we're just lucky as heck to get to lead people like Monica to a different way of life.
And Eddie, we've got 50 more examples like you just showed there, right? And that's what we're seeing, right? Yeah, her rent went up $400, but her expenses go way up. And then your house is doubled, but you got this money tied up, and this is the solution, right? So whether you do have rentals, or if you don't have rentals, or if you're thinking about getting rentals, stay tuned.
Look, Monica had rentals.
She did, absolutely.
Some people are considering rentals.
Yes.
And some people are just considering, what should I do with my money today? So you got people in different stories and different situations. Monica had rentals. So converting those rentals and becoming, the lender versus the landlord, that made sense to her.
Yes.
But for some people, they're contemplating it.
That's it.
Like they haven't quite done it yet. They're just thinking about it. And they're like, wait, are you telling me this is more profitable than I was thinking I was going to do rentals? No, you really probably ought to look at this. And then some people are like, heck no, I already have friends at rentals and they don't want to go deal with the brain damage. Yeah. So like some of you are Monica at different areas of her life, because she wasn't born with rental property. She just started it. Right.
So because that's what she thought. That's what she was taught, right? I mean, how many people have we trained over the years that go, God, I wish I'd have found out about this 10, 20, 30 years ago. I mean, we hear it every day.
Here's a question, Joe. Who makes more money on the rental? The landlord at about 4%.
Yeah.
Or the bank or the lender, right? Whoever made the mortgage loan at about 7.5%.
That's it.
I'm not a genius in math, but I know that 7.5 is more than 4.
You can't earn 4 and pay 7.5. It doesn't work.
Yeah. So and what do we have here? Well, when you're the landlord, you have taxes, right? You got to pay the taxes, and you've got insurance, and all of those have gone up drastically, right?
Yep.
And then you got repairs and maintenance, and and then you got upset tenants, and unfortunately you get to answer for all of those. And when you're the bank or you're the lender, and you're saying, well, what does he get? He gets a check every month. You don't call him with tenants and toilets, right?
Right.
And so that's the truth. And that, it could be a bank or a mortgage company or whoever it is. But do you know, Joe, that you could be the lender on your house?
Absolutely.
You could be the lender and loan money on your house.
That's
it. So here's the house. Here's the house that we looked at. And so today we're going to say that you could do seller financing on all of these asset classes, right? Every one of these you could seller finance. But specifically today, we're going to focus on rent houses. Okay. So here's the dilemma, Joe. I got a rent house. I could keep it as a rental, or I take the same house and I could just owner finance it and sell it to a buyer. But I'm going to also loan them the money to buy it.
That's it.
Right. So I'm not going to rent it anymore. I'm going to seller finance it. This is exactly where Monica was. It's exactly where she landed. Okay. So we're going to sell the house and finance the buyer, right? We're going to carry their payments over time plus interest instead of her having to go to find somebody else to loan her the money on the house. Joe, I'll loan you the money, so to speak, right?
Right. Yeah. Yeah.
So you can first sell your current rentals and be the bank or be the lender, right? And then the second thing we're going to show you in this exercise today, what Monica then learned was a big fact, is that you could then use a leveraging technique, or you could see, everybody knows if you have a rent house, you could borrow money against a rent house, right? But very few people know if you have a note, how you would go get some of your money back.
Right. Recapitalize.
We're going to show you how to do that. Right. So I get to teach this for some of the hotshot real estate masterminds in the country. So these are call it the top 500 house buyers, and about 3 or 4 different masterminds, smart people, good people, but they face this exact same problem that Monica was facing. In fact, Joe, I won an award earlier this year, and they're like, "Oh, Eddie," like I was actually saying the same thing a year and a half ago, and Monica kind of caught on to that then. But once again, people were listening now because of the economy and the market, and one things just quite honestly were different, right? So that was our crazy picture, by the way, Joe.
Yeah, yeah.
You know what I'm saying?
Yeah.
So here's the house, and you could rent it. But what if you took the same house and you said, let's do the other side. Let's look at what me carrying the financing for the buyer, or carrying the payments for the buyer, including interest.
Right.
And so we've heard it called a lot of different things. And so if we use a term today that sounds different, we use the word notes, right? Well, a note is just really where you're financing the buyer. You can call it seller financing. You can call it carrying a first mortgage. You can call it paper in a deal. You can call it being the bank. Like, all of those kind of mean the same thing. So don't let us confuse you, right? It's just this is where you just decide, I'm going to be a lender instead of being a landlord. Right?
And we're going to do the things that a bank will be that a bank does to make sure that borrower is a good borrower, right?
Yeah, this is what Note School really helps people how to do, is how to structure the loan, the terms of the loan, the terms of the sale, and how to underwrite it, and how to we teach people how to do this really correctly, and that's what we've helped Monica learn how to do, right? Absolutely. So the idea here is the house was worth $250, so I'm going to sell it for $250,000, and I'm going to get a good down payment here. I'm going to get a market condition of 15% down.
Right.
That's the buyer. So the buyer now is paying 15% down. Okay, he's paying a 15% down payment. And then I'm going to be the bank. I'm going to seller finance them, and I'm going to carry that at what are called non-QM rates. and the average rate for that is about 10.5%.
Right.
That makes my mortgage payment that I'm receiving every month $1,943 a month. Now, Joe, I was getting $1,800 in rent.
Yes.
Right. So you're saying, okay, Eddie, you're getting a little more money. I'm renting it for $1,800, but now I'm getting a payment of $1,943, so up $143 more a month. What people don't realize about seller financing is there are some tax hacks, and we're not going to get into all of those today, but there are definitely some tax hacks with carrying owner financing that most people don't know. And there's Note School, as you progress, will teach you some more specific details on how those works. There's also multiple exits. There's different ways you can do this. There's not just one way to do it. And the problem is the industry problem, which Monica figured out totally, is that her equity was trapped. Right. And if you seller finance, you're now getting paid for your equity, right? Your equity is the difference between what it's worth versus what you owe.
Yeah.
Okay.
And, Eddie, to get that equity out, if you're going to keep it as a rental, you've got to go out and borrow money against it, paying 7.5% while you're getting 4%. And then your numbers really don't work anymore.
Yeah. The bottom line is, if